right, everyone, we are going to get started here. Thanks for signing up to attend this private money lending webinar today. I'm going to try to respect your time. We'll see how we do today and see if we can get through this in just about an hour. And let's get started. So I always like to start with this quote. I love this quote that I heard once. And the reason is because we're constantly looking for ways to change, ways to improve, ways to do something different. And if you're attending this webinar or watching this online, you know that's the case for you. You're looking for just a little bit more. What else can I do? So I love this quote. He says, people change in 4 different seasons, either when they hurt enough that they have to, or when they see enough that they're inspired to, or when they learn enough that they want to, or when they receive enough that they're able to. And anyway, that just stuck with me through all this time, and I love sharing it with you guys. And it's so true, just like what inspires change. And so today, as we dive in, I hope that'll inspire you to just change the way you think about your money. All right. So my name is Jason K. Powers. I'm with 1024 Wealth. I always tell people, change the way you think about your money, and it will change your life. I've done my fair share of real estate investing over the years. I've been in this practice for about 7 years now, and I love what I do. I love teaching those in the real estate world about this. I love teaching business owners about this because those people, you guys, understand cash flow and the need for money to move. And so I think that'll help. So we have this need for generational thinking. I think we've lost that over time. We kind of, as the generations come along, we're less and less concerned about what's going on with the next generation. And I want to show you today how this vehicle not only will help you now, but will help you for generations to come, for that matter. There's a need for life insurance and estate planning. I think a lot of people go, oh, well, this is a boring topic. I don't want to hear about those kinds of things. I'm not going to talk about this much today in the estate planning side, but I want to acknowledge it, and there's a need for it, and I think we need to come back to it. There's also a need for income protection. We insure virtually everything we do in our life, except we don't insure ourselves enough in the context of what happens if we're disabled and we can't work. We are the machine. If we're the machine pumping out X amount of income per year, would we not want to insure that machine? But there's also a need, more importantly than everything else here, I think there's a need for controlling the banking function in our life. And that's what we're really going to dive into today. So I want to talk about this one human behavior. It's talked about in Nelson Nash's book, Becoming Your Own Banker. If you haven't read that book, please go out and get it. The human behavior, it's called the arrival syndrome. It has the main component to it is we already know all there is to know. And basically it's just saying, hey, let's take a minute and understand there may be something in this that we don't know yet. Maybe we've heard derivatives of what I'm about to show you today, but you probably haven't heard it from its source, so to speak, at its purest form. And that's how I'm going to try to teach you this process today. So Nelson Nash, I love how he puts it. He said when this arrival syndrome infects us, we stop growing, we stop learning, we rot, we tune off or tune out the ability to receive inspiration because we already know all there is to know. So I encourage you just to be open-minded today as we talk through this and stick with me, and I guarantee you will learn something new. All right, Nelson Nash again. I love quoting him. He has all kinds of good stuff. And he says the most profitable thing you can do is learning to control your money. We have to change the way we think about our money. Here's one example I love to give just for context for a lot of people because they don't realize it. So if you had $30,000, would you make more money if you loaned it out to somebody amortized 6% for 5 years? Or would you make more money just putting in a CD at 4% for 5 years? Okay, now at a glance, the average person goes, well, that's a stupid question. 6% is more than 4. So 6% makes more. And I said, well, okay, let's do the math. That's all right. 6% amortized 5 years, you would make $34,799. 4% in a CD for 5 years, you would make $36,629. Well, Well, why is that? Well, it's because of how the numbers are growing. Amortized, you're paying 6% on a lesser interest amount every year. CDs are compounding. If you're leaving that 4% in there, it's compounding the right direction and it's growing. So the uninterrupted compounding of that CD can outpace the amortized interest loan, even at a lower interest rate if you're just looking at interest rates. So I point this out to say, hey, let's do the math. Let's not always assume, well, 6 is more than 4, because it's not always that way. We really need to look behind the curtain and go, well, how is it actually growing? And then I want to show you today, what if you could effectively do both? Put money in a vehicle that's growing uninterrupted. I'm not here to sell you CDs today. Let me get in front of that. In something that's uninterrupted, but you can also take it and loan it out and make money elsewhere with it. And that's what I'm going to show you today. And it's time to think differently about our money. Enter the infinite banking concept, okay? So this infinite banking concept, if you've never heard of it, again, I said grab that book, Becoming Your Own Banker by R. Nelson Nash. It's a 92-page book. It's a quick read. It is the foundation of everything else we would do in the IBC space. So the infinite banking concept is really a process. It's not a product. So IBC, we talk about, it's about controlling the banking function in our life. That's the concept itself. It's about how do we put our money into vehicles that we have control over, not other vehicles that we have zero control over. Think of a good example would be putting our money in the stock market, right? Who has control of that money? And certainly not you, okay? Or utilizing our cash from banks, from bank loans. Who has control in the end? The bank. Now, this conversation for you guys, you are effectively the bank for a lot of people in what you do in your business and private money lending. So, but the concept itself, again, is about controlling the banking function. Where can we put our money into a vehicle that we have more control over? And what is it doing for us? So the infinite banking concept, it's a place where we can warehouse our wealth. It has guarantees, safety, ready access to our money, and can help us take over that banking function. Now, the vehicle through which we show people how to do this is properly structured whole life insurance that is dividend paying from a mutual carrier. So I'm wordy about this, a lot of little details, but I'm very particular about it because it's not as simple as, hey, just go get life insurance, just go get whole life insurance, whatever. It's not quite that simple. It has to be properly structured in a very specific way to maximize what's called cash value, access, and growth inside of your policy. So I say properly structured. We say whole life insurance. For today's conversation, we're talking about whole life insurance, no other kind. I will explain that here in a minute. We're talking about dividend paying from a mutual carrier. Why do I say that? It's because there are two types of insurance companies. There are stock-owned companies. Its interests are for the stockholders. And then there's mutual carriers, insurance carriers. Whereas a policyholder, you're effectively one of the owners of the company, thus entitled to the profits, which come in the form of dividends. Okay, so we say dividend paying from a mutual carrier, whole life insurance that is properly structured in a very particular way. So if you're not familiar with insurance, let's define the terms for just a second here. All right, two primary types of insurance. We have term insurance. I think most people are familiar with. It's relatively cheap. You pay a premium, you get a death benefit. That's the premium side on the left, and the insurance is your death benefit on the right. Whole life insurance or permanent insurance is you pay a premium, you get a death benefit, but somewhere along the way, you start building what's called cash value. And you see that in the middle. Now, dollar for dollar, if we're paying the same in whole life versus term, we're not getting as much death benefit. So in order to get the same amount of death benefit as you would in term early on, that's why we perceive it as expensive insurance. I think the general public's understanding of whole life insurance is just expensive insurance, you know? And what we don't realize is that, and even agents out there that are selling whole life insurance, many don't realize you can actually restructure that policy a little bit to be a little bit more advantageous for you along the way. But you have cash value access. That cash value, in all whole life cases, you're allowed to borrow against. Okay, that's what we're going to talk about. But that's not what we're doing. We're taking properly structured whole life insurance. And now, so the top is your classic structure I just showed you. The bottom is how we're going to restructure that policy. All right, so at the top, you've got your premiums. The bottom, we're taking the premiums, but we're breaking it up into two parts. So let me give you an example. Let's say it was 10,000 in premiums, 10,000 a year in premiums. Well, instead of just it going toward what's called base premium, we're actually going to break it up into base premium and paid up additions, or PUAs. So you're going to hear me reference this a lot today as well. So because we've broken it up, don't get caught up on the ratio. We can change the ratio between base and PUA. But effectively, the PUA and the base are buying death benefit at a different rate, more or less. And because you're doing that, you get more access to cash value along the way. And that's the purpose of us wanting to do this. We want to structure it this way because we want more access to cash value along the way. And then you borrow against that cash value and you use that money to make you money or save you money throughout your life to control the banking function in your life. And we'll dial this in. So high level perspective is save. That's funding your policy. That's funding your banking system. You borrow against that system. You put it out there to make you money or save you money. That's the invest side. You're borrowing from yourself, so at some point, pay yourself back, right? That's the replenish side. And then repeat, rinse and repeat. And so this cycle can go on and on and on and on and on throughout your life. Let me talk about the benefits for a minute. The single greatest benefit, in my opinion, is the fact that your cash value will sit and grow uninterrupted throughout your entire life, even if you've borrowed against it. Let me say that again. The cash value inside of your policies grow uninterrupted throughout your entire life, even if you've borrowed against it and are using it elsewhere. There's simply no other vehicle out there like that. There is a guaranteed growth component to it. It's income tax-free growth. You're going to see there are what we would look at as gains inside the policy throughout your life. Those are not taxable because you will always access them as policy loans. It is safe from investment bust. This is not an investment vehicle. This is not an investment vehicle. This is an asset. Okay? So there is no market correlation in here. Unstructured loans, when you borrow against your policy, you can control the loan terms. Loans are not tied to your credit. You, me, and the insurance carrier know about it. You can use it now throughout your life and even use it to supplement or be your retirement later on, which I'm going to show you that here at the end. And of course, we've mentioned life insurance, so there's a generational wealth transfer component to it. Okay, so that's real high level. Now we're going to get into a couple of case studies and pack in a lot of numbers. And I'm going to try to go slow enough, but fast enough we can get you done in an hour. But I want to show two different case studies. Don't get caught up on the dollars per se. Don't say, oh, well, I don't have that much, or oh, that's not enough, or whatever it is. Don't get caught up on the dollars so much. Just understand the principles of what's going on behind the scenes. How is it working? How is it growing? What is it doing for me along the way? All right? So let's dive in. This case study was based on a client of mine, and they are a private money lender. And they were putting some money in for the first few years, and then they were going to ratchet it down. So I'm going to show you this. All right. So let's look at these arrows on the left-hand side. You'll see the premiums by those numbers. I'm going to also get a laser pointer here. See the premiums here are what they're going to put in over time. So they're going to roll in $100,000 a year over a 3-year period. And then we're going to reduce it down to 50 for the remaining 10 years. And then after that, we're going to reduce it even further down to 19 and change. Now the base, remember we had two parts. The base premium is really 19 and change, and the rest is PUAs. It's really about 20, and the rest is PUAs. And then we drop another rider off of here that makes it 19. So anyway, so what happens is here over on the far right is your cumulative cash value accessible that particular year. So just like starting any business, when you start your own business, there's a capital investment involved. And it takes a year or two or three or four, right, for you to start getting your money back, really. So think of this like you're launching your own new privatized family banking system business. So the first couple of years, you can't actually access as much as you're putting in. However, you can access a bunch of it. So you see this very first number is 77 and change, 77,000 and change. So they put in 100,000, let's say day one, and effectively day two, they could turn around and borrow 77 and change right back out. So they're not out 100,000. They're not tying up 100,000. They're tying up the difference, just under 25 the first year, but for future benefit. Second year, they put in 100. Third year, they put in 100. Then we ratchet it down. So you see from years 3 to 4, if you look at the cash value here, it goes from 269, let's say 270 to 325. Now it starts growing more than their premiums are being put in. And that spread gets larger and larger every single year. You're going to see here after 10 years, they've put 650,000 in through their policy cumulative. They have 722,000 in cash value accessible. Let's go 10 more years. That number gets larger and larger. After 20 years, they've put in a cumulative 841,000. They've got a cumulative 1.3 million. The difference, if you will, is not taxable because it will always stay inside of your policy and you'll borrow against that. Okay? And then you're going to go make your money with that money. So you borrow it and you loan it out at your 10 and 2, 12 and 4, whatever you're doing. All right? So let's break this down in spreadsheet form. So remember, this is the same numbers over here, the cash value I was just showing you. So say they took 75 of it out, loan it out at 10 and 4. I annualized this, so let's say twice over they did 10 and 2 throughout the year. So that's where I picked 10 and 4. They make about 10,500 and so on and so forth. You see these numbers. The second year, cumulative, they make 23,000, 37,000, 45,000, and so on. But then, so at the end of that 10 years, cumulative, from lending, they've made a little over $500,000 from lending. But now, remember, I've been saying borrow against your policy. So what happens is there's actually an interest cost to borrowing against your policy, and it's right now, policies are 4% fixed. So for the whole rest of your life, you can borrow against your policy at 4%. I'll explain that in a few minutes, why that's the case, how that works. But let's talk about the numbers here. There's an interest cost. So the interest cost over that 10-year period was $164,000. But let's do the math. So the profit from lending, the first 10 years, they made $576. Let's subtract out the interest cost. So the net gain was $411,000. Plus, remember I talked about the cash value increase. So the first 10 years, that cash value increase above and beyond the lending money you made was an additional $72,000. That $72,000 is not taxable because it will stay inside the policy. The IRS does not tax on policy loans. All right? So that $72,000 is income tax free, stays inside your policy. So your new net gain is about $484. But let's look at what happens the longer we go. All right? Let's look at the second 10 years. The second 10 years, I want to remember we reduced the premiums. We have the loan interest here, which we want to address. The second 10 years, our dollars are a lot more, so our loan interest is a lot higher. And we're assuming we're loaning out about 100% of what we can within our policy. So the interest was a little over $400,000 the second 10 years. But here was our cash value. And loaning it out at 10 and 4, right? It can be whatever you want. If we loaned it out at 10 and 4, 10 and 2, twice over, whatever. Over that second 10-year period, we made $1.4 million in lending. Because our dollars are a lot more, right? They've been accumulating. You're recycling the dollars over and over and over again. So how's that look on paper? Profit from lending, 1.4 minus the 400, so we made about $1 million net, Plus, what happened to our cash value increase that second 10 years, I wonder? So the second 10 years, our cash value increased an additional $388,000. Again, income tax free, it stays inside the policy. You'll borrow against your policy. So that means we truly went up about 1.4 million over the 20-year period. Our total cash value plus lending profit is 2.3 million. All right. I've been saying borrow against, and there's an interest cost. So I want to talk about that for a second. On the screen here, you see you is you, carrier is the insurance company, private family bank is your cash value. So what happens is you call the carrier, say, hey, how much can I borrow against? They look at your policy. They say, okay, well, you have X amount. You can borrow X amount against your policy. You say, okay, give it to me. What they will do is they will loan you their pile of money, and they'll charge you an interest rate. Every carrier is different. Every number is different. The one I use the most has a 4% fixed option when you get your policy. There's a 4% fixed option for the rest of your life. You'll never see those kinds of interest rates outside again. All right, 4% fixed. But they loan you their pile of money all the while your pile of money will sit and grow uninterrupted. Understand? So they're loaning you their pile of money so that your pile of money can sit and grow uninterrupted. Take you all the way back to that first example of that CD that was compounding uninterrupted at 4%, and it was outpacing a 6% loan elsewhere. So that's what's happening inside of your policy. The compounding effect is taking place and snowballing year over year over year over year inside of your policy. And then you're taking that money and you're taking it out and you're making even more money with it. Because this vehicle is not an investment vehicle, right? This is putting money through. It has guarantees, it has safety, it has security. It's not market correlated. You know what it's going to do. Plus, it's life insurance. So we haven't even talked about the death benefit yet. All right. Let's dive into case study number 2. This one is very numbers heavy. So I'm going to try to go slow and break it down for you. This is a person who's pushing $2 million through their policy over a 5-year period. Lots of strategies we can take. So they have $2 million that they're lending in and out, in and out, in and out. So because of limitations in death benefit, et cetera, we can't just drop $2 million in there day one into the policy. So we're spreading it out over 5 years. And I love spreadsheets, which you're going to see more of here as we go. But so we're going to spread that out over 5 years, and then we're going to reduce premiums after that, and then even further after that, which you'll see. All right, so let me show you these numbers for a minute. I want to talk about this. There are several things going on in this illustration. So here we have 2 sections, okay? We have guaranteed and non-guaranteed. The non-guaranteed side has the dividends, which we've talked about. Remember, dividends are profits, and a company is not allowed to guarantee profits. However, this carrier in particular, I know, has never not paid a dividend in 125 years. So I'm very comfortable using this side showing dividends. Okay? Now, let's see if I can figure out how to erase what I just did. Okay, so we have the dividends on this side. We're really only going to look at the cash value over here because of the dividends. Got it? So you'll see on the left-hand side, their premiums on the left-hand side are $400 a year, the first 5 years, and then we reduce premiums after that down to $100. And then at year 15, a little bit more, and I'll show you the second set after the retirement as well. And so this is what's going on. Now, again, very numbers heavy, so we're going to try to break this down real slow for us. All right. So that's what's happening. Plus, we haven't even talked about the death benefit yet. Again, the death benefit that correlates with this, which is growing and growing and growing and growing throughout your life. So the cash value is what we're focusing on. We're going to utilize this cash value for lending So think about this. We're just changing the flow of our money. Instead of going from bank account to lending, we're going bank account through a policy, borrowing against the policy, and then loaning it out and making money with it. All right. And then we're making money outside, plus our policy is growing inside, the cash value access you see in there. All right. The white line in the middle here is our cumulative premiums we paid throughout our entire life. The yellow is our cumulative cash value that we have accessible. And then we have the death benefit way above and beyond that we're not really going to address at the moment. But you're going to see along the way, no matter what the dollar amount is, again, don't get caught up on the number of zeros. The dollars you're putting in through premiums are going to grow uninterrupted throughout your entire life, all right? The cash value will grow uninterrupted. So on average, the way we structure these, somewhere between years 2 and 4, the cash value begins growing more than the premiums, whatever the dollar amount is. On average, somewhere between years 6 to 10, the cash value catches up. The cumulative cash value exceeds the cumulative outlay of what you paid in. So it's caught up for the first couple of years. So you see here, for example, is from years 3 to 4 in this case. They're paying, again, remember we were doing $2 million over 5 years, so $400 a year. And so they put in $400 and start growing more than $400,000 this year. And they have access to all this cash value along the way. Okay, and then fast forward, you see here, he's got 2.2 in throughout that 6-year period, and 2.2, a little bit over 2.2 in cumulative cash value. So that number, that spread gets larger and larger and larger the further along you go. So you see they put 3.1 million, almost 3.2 million by age 65 cumulative throughout their entire life inside of the policy, but they got 4.6 million in cash value accessible. That 1.4, 1.5 million difference, not taxable because it stays inside the policy. They'll borrow against the policy, and the IRS does not tax on policy loans. And fast forward all the way, this person to 85, they've got 12.2 million in cash value accessible. They've got the cumulative 14 million in death benefit built up. And they still, remember, look at this 1.2 million, 3.2 million, sorry. At age 65, you see that flattens out. We've stopped paying premiums. So they paid no premiums. They put no more dollars in. And their cash value, look what it's still doing. So over a 20-year period, from age 65 to age 85 in their case, it grew from 4.6 million to 12.2 million in cash value. They didn't put a single extra penny into their policy. That's the power of uninterrupted compounding. That's the power of this vehicle in particular. Okay? We're going to take this, put it in a spreadsheet, and break it down and say, great, that's this isolated. What are we going to do to make money with it? All right? So let's look at this. So, again, a lot of numbers. Let's break this down. We have cumulative premiums on the far left. Let's go cumulative premiums on the far left that we paid. Years 2, 3, 4, 5 through 10, and then I did 15, year 15 and year 20 down there at the bottom too. Okay, policy cash value, we're going to back out the 4% cost. So this is the cash value that was listed. We're only going to use about 96% of it so that we have a buffer for that interest rate in case we don't pay it back. All right, so 96%, the policy cash value is here. Now, what I did was over that 5-year period, we're rolling 2 million in. So year 1, we rolled 400,000 in, but we still have 1.6 million outside over here in the middle that we can loan. You understand? So 400 in to the policy, we have 1.6 left we can still loan out. That's outside the policy. We'll take the cash value that's inside the policy, also borrow against that and loan it out. Okay. So I did a 10 and 4 throughout the year. I just averaged it out. Let's say it's 14%. We can make 14% flat throughout the year just for easier math. All right. So cash value, I backed out the 4% cost. So let's say a 10% net gain of cash value that particular year. Okay, you with me? So cash value here, and we're calculating how much you could make on that cash value at 10% that year. And then we have what's remaining of our outside money that we're slowly rolling in each year, and we're making 14% on that. And then added together is this green column on the far right. Right, so cash value, cumulative cash value, as we're rolling that money in over the first 5 years, the outside money is decreasing. And so because we're trading, we're kind of setting up our system early on. Our gross gain, we're doing a net 10% instead of 14%. However, we're creating a system that's going to begin compounding and compounding and compounding throughout our life. We can borrow against this policy. The cash value growth, remember I showed you, started about year 3, year 4, where cash value was growing more than the premiums. So that's the year it begins growing more. I'll show you here in a minute. But you see, the further along we get, that number starts jumping. And down here at the bottom, we get a pretty reasonable number throughout our life. Let's say 20 years. This is the first 20 years. This is based on a 49-year-old. All right. But what happens next? So we're taking the same numbers. We had the profit we're making from the cumulative 2 million that we're pushing through a policy. And over time, we make a cumulative, 3.1 million with that money over time based on 14%. But what we haven't talked about yet is the cash value growth inside the policy. So I've got money out making me money, but I also have cash value growth inside of my policy. So that is, you see the growth here. I showed you on that graph, but this is the numbers form, right? So it takes to about year 4, and then we're tipping. So cash value growth, just a couple bucks year 4. Now it starts jumping. Above and beyond my lending money, I'm making cash value here. And that money is going to compound throughout its entire life. So our true net gain you see here. So we jump instead from about 3.1 million up to 4.2 million. And we've got this massive death benefit to address. Now I'm going to go back one and just kind of recap this because it's so many numbers. So the idea behind this is we're relocating money instead of it just sitting in a savings account. Once that money is loaned out from our original pile, it can only grow on what we've loaned it at. And if we have any left in a savings account, it's only growing on the money you left in there. So if I had $2 million, I loaned out $1 million of it. The remaining $1 million in the savings account is only growing on whatever that savings account rate is, right? What is it, 1%, 2% right now? Okay. If I have $2 million inside of my policy and I borrow against that policy, it's going to continue growing as if the money never left. So you see here, the cash value. That cash value, when I borrow against this 2 million right here, it's going to continue growing as if the money never left. And there's just simply no other vehicle out there like that. Uninterrupted compounding throughout my entire life. I could get all the way down here, 20 years in, I've got 5.4 million in cash value. I could borrow against that. I could take $5.4 million loan. It's still going to grow the next year as if the $5.4 million is still sitting in there. And then I went out and made money with this money also. So it's a matter of thinking long range. So many people look at this and they're just looking at the first year or 2 or 3. and saying, I'm losing money. It looks like I'm losing money. I say, well, one, it's not an investment product. Two, think of it more like starting a business versus an investing vehicle, right? Because it's not an investment vehicle. There's no market correlation. You started your own privatized family banking system, and it costs you a little bit of money up front. But now the lasting power of that snowballs and snowballs more and more and more and more. So that the further along you get, the more you've got this uninterrupted compounding growth. So I'm not going to sit here and tell you and talk about how to loan it out and make money with your money out there. Because you're the private money lenders, so you can loan your money out and do that. But I want to show you how just by changing the flow of the money, you are creating this cash value growth inside of your policy. Let me talk about this for a second. If you start comparing what are dollar for dollar, what can I make outside of the policy? If I didn't put my money inside of a policy, because let's talk about that. The math is it looks kind of off over time. You say, well, look, I cut pretty close on just keeping it out. But I would say, look at this. This is your taxable burden, the 3.8 million. Your cash value, this is cash value growth, okay? This is not your net cash value, which I'll pull back up. This is not taxable because it stays inside of your policy. You just shaved off $1 million from your taxable burden. So every dollar gained in here, not taxable. Versus every dollar gained just in private money lending, taxable. You understand? So not only are you looking at what you would consider rate of return, you're looking at what's the taxable implication as well. And am I saving any money there? But now let's take this one step further. Let's say we get to 65 or 70, whatever we want to do. So let's say we get to 65. This is the same illustration continued on. You see way up here at the top left corner, age 65. They've paid $3.194 in premiums throughout their entire life. I'm actually going to do this here. They've got a cumulative $4.6 million in cash value up here, plus the death benefit, $9.2 million that's accumulated. Now, at this time, this person will choose to do what's called a reduced pay up, meaning we just stop paying premiums. So no more premiums are going to be paid for the rest of their life. We make the policy what's called paid up. So that's why you see a little bit of adjustment in death benefit this year. We paid it up, so they adjusted the death benefit a little bit, and then it starts growing again from there. But look at my cash value. I've stopped paying premiums. What happened to my cash value? My cash value continues to rise year over year over year over year over year. By the time I'm 81, I've got $10 million in cash value sitting there if I haven't touched it, right? This is just assuming gross 10 million in there for not putting any money in. That's not bad. But how do we utilize this for retirement? Well, I know, I'm going to go back. I could make this money last me about 10 years, maybe, if I were taking $300,000 a year out. Okay? Because I've got taxes to deal with. And then I've got my principal, $2 million. Here, we could take a $300,000 a year policy loan out if we wanted to. We borrow against our policy, $300,000, income tax free from our policy. And it'll just reduce any outstanding loans and interest that's not paid will just be reduced from the death benefit at the time of death. So that's why you see this number now decreasing over time, because this is working under the assumption if this particular year this person passed away, this is how much death benefit would be left had they borrowed $300,000 a year out for these 15 years. You with me? And if they were to live to 85, let's say they passed away at age 85, and they lived on 2.8 million over that 20 years in retirement, it would still leave nearly a $3 million death benefit to the beneficiary above and beyond that. And I think that's the power of compounding. That's the power of what these policies can do. Now, certainly, not everybody's going to borrow this much every single year. You know, you're living pretty good at $300 a year in retirement. And you can pick a number. It can be any number. You can make it whatever you want each year. You can do it each month. You can decide how much do I want to take this month. A lot of people have qualified accounts as well, 401ks, IRAs, etc. So what a lot of people will do is they'll take their RMDs, the required distributions, and then if the markets, if they were taking more than that, if the markets are down that year, they'll maybe leave that money alone and just borrow against their policy instead. If markets are doing awesome that year, maybe they'll take the money primarily from the investment and then leave the policy money in place. So you can go back and forth, pick and choose what makes the most sense at retirement. Okay. So we either use velocity or we lose it. All right. I want to take this one step further, and then we'll stop for any questions there might be and wrap it up for you guys. So I'm a big advocate of generational wealth. I have children. If you don't have children, I think you can even think about what other ways can I leave a legacy. I have a family I work with. They are third generation funding a foundation in the Midwest, and that foundation is now named after that family. And they do a lot. They have a library. They have a lot of different things, and it is paramount. And this new generation, he has no kids, so he's leaving most of that money to this foundation. So anyway, it doesn't just have to be children, but this is from a generational perspective, from a family perspective, this is one idea, one option. This is actually what I have in place and what I'm doing. So the first generation has to start something, all right? And then ensure the next generation. Get policies on the next generation. The beneficiary of my policies is my family trust. So the death benefit upon my passing dumps into the family trust. That family trust has boundaries, let's call it. And it can operate as the family bank at that point. So now my kids, my grandkids can borrow against that trust. And they can use it for other special things, marriages and first homes and things like this as well. But they can borrow against that. So they now have this family banking system in place from the trust. The trust is now buying policies with its money on each living generation. So the trust has bought policies on my kids. It will. And then it's going to buy policies on the next generation. The beneficiary of those two generations, of those policies, is also the trust. So each generation, upon each person's passing, the death benefit funds that trust more and more and more and more. And that trust has a larger and larger and larger pile of money to work with each and every generation. Because it's going to use it, it wants to use it in ways that it can recapture money or grow their money, not just give away. And so each generation, again, the death benefit is funding the trust. Also, whether it's a trust or individual, the policies you own, so in this case, the trust will own these policies. Whoever owns the policy controls the cash value. So I have policies on my kids right now. I control the cash value of those policies of my children. So I can use that cash value however I see fit. So you can imagine if the trust is purchasing policies on multiple generations, it not only has its principal amounts that it's been funded with each generation, it has the cash value inside of those policies as well that it has access to. And that, my friends, is how you can set up 2, 3, 4 generations from now. There's some people out there you may have heard of called the Rockefellers. That's why they are 6 generations in, still going strong. This is one of the many reasons, but this is the primary, a strategy like this is what's running behind the scenes. How do you set something up that self-perpetuates? It just keeps going and going and going and going. Okay, so a lot of people all the time, every week, I'm going to do this one day. I'm going to do this one day. This is great. I'm going to do this one day. And I would encourage you, make today day one. Make one day having come. Okay. And let me go back and actually make today day one, right? We have to change the way we think about our finances. And it's just, I'm not changing your private money lending strategy. I'm changing the flow of your money. You're still going to take money and loan it out and make money how you make money. I'm changing the flow of the money and saying, not only can you do that, you can also do this. And it's working 2 places at once at the same time. Okay? So I'm going to stop here for questions. And I want to answer the first question, kind of going back a couple of slides. The death benefit, in most cases, there's limits. $3 million death benefit, $5 million death benefit, no problem. The death benefit is not taxable to the beneficiary, okay? Now the government and the IRS has come in and set very high limits for very high net worth people that you'll run into situations. But for most people, death benefit is not taxable. The general public, certainly not, until you start hitting millions. And if I have a $50 million death benefit, there's some taxable problems you'll run into. That's not a problem for most people. So, death benefit not taxable. That's a good question. Feel free to type in the chat if you have any questions, and we'll try to get them answered. A lot of people ask, well, what's this cost? What are you paying me? And I will tell you, the only money out of pocket you will run into with me is whatever you put into premiums. So I do not charge you for the strategy planning. I do not charge you for the education. We simply say, hey, I'm going to help you in this process, and we'll put together a good plan for you, and then I will help you implement that policy and issue that policy for you. So dividend rates vary each year. A carrier will declare their dividend rates. The question was, what is the assumed dividend rate that you are using in the model, and is that showing up in the increased cash value? Okay, so a few things contribute to cash value growth. One, you have guarantees. They have a guaranteed side of cash value growth. 2, you have paid up additions, which in most cases, we stopped after the first 10 years. And then we have dividends. So dividends and PUAs are constantly buying more death benefit. Because you're buying more death benefit, you're getting increased cash value, plus the guaranteed growth. So this dividend rate on these illustrations, I ran those illustrations for this just about a week ago. So I think the dividend rate is 5.5 on that. And they declare those each year. But because the dividends stay inside the policy, there's no taxable implication. Constantly buying more death benefit with it is really what's happening behind the scenes. What other questions do we have? Am I too old to start? So what happens is, because it's life insurance, all these factors contribute to the cost of life insurance. Age, health, even gender. Women are cheaper than men, and things like that. Sometimes your job, if you have a risky job, that can create a more expensive policy because it's more risky. So all those things contribute to the cost of insurance. Now, generally, once a person hits their 70s, it's generally, not always, cost prohibitive to get a policy on yourself for the purposes of infinite banking. I'm not saying for life insurance, I'm saying for the purposes of infinite banking. And then it becomes a little bit cost prohibitive. We can do it. I know people that at 72 that have gotten policies. It certainly can happen if health is really good and the numbers make sense for you. However, I would then say if we are hitting ages or health situations where it's a little bit cost prohibitive for you to get a policy on yourself, let's look at those around you who have insurable interest. Your spouses, your business partners, your children, your grandchildren. Can we insure them? Can you put that money through a policy for them instead? Because they'll have a better health rating, you get better growth. And you own that policy, remember, so you get to utilize the cash value as you see fit. Now, eventually, you would hand ownership of that policy over to that person or someone else who would rightfully own the policy upon your graduation. But for all intents and purposes right now, while you're building the policy, you would control the cash value and use it how you see fit. So I would tell everyone, don't let your own age be a hindrance of us sitting down and exploring what we can do for you. The general process, what's the process was the question. The general process is, let's sit down and talk. This is not a one-size-fits-all approach at all. This is a very customized approach and built strategically for you and your situation. So I gave you just 2 high-level examples. We've got 100 examples we can show you. If you're into real estate investing, wholesaling, fix and flips, buy and holds, commercial, any of that, I've got lots of wonderful examples to show you how to utilize it there. Businesses, debt recapturing. We've got there's lots of ways to use this. Don't think this just has to be used this way, right? If you're not using all of that money for private money lending, could you use it to replace the bank? Otherwise, you have car loans, you have your own mortgages. Where can you replace the banking system in your own life? Can I borrow against my policy and pay off my car from the bank and just pay myself back? I was going to pay somebody the money. Why not pay myself back? I was going to put a down payment on a house. I was saving. Why not save inside the policy, put the down payment, and pay yourself back over time at your own pace? Whatever it is. You want to loan your niece money so she can buy a car? Do that. You want to use it for yourself to buy a motorcycle? Do it. Pay cash for it on your own and pay yourself back over time. Lots of ways you can use policies to save you money, make you money. But the concept itself, again, is about controlling the banking function. Go out and get Becoming Your Own Banker by R. Nelson Nash and read that. You can get it on Amazon. You can get it on my website. Lots of places you can get it. And check it out. I think that's an important read as well. Scan this QR code. Schedule a call with me. You can email me. You can text me. Go to my website and poke around. I would love to hear from you guys. Let's set up a call. Let's talk. Let's see what you and your situation is. Thank you for your time, guys, and I look forward to chatting with you soon.